what is the Fed funds rate? How does it affect mortgage rates? And how does it impact the economy and your business? I'm Sullivan, CPA and founder of Facts, Figures, and Fallacies from the Front Line. Today we're going to look at the history of the Federal Reserve and how it sets the Fed funds rate, what is the Fed funds rate, and how it impacts your business. So let's look at what is the Fed funds rate. The Fed funds rate is the interest rate at which banks lend reserve balances to each other overnight. That rate is set by the Federal Reserve, but here's the twist. Before 2008, the great financial crisis of 2008, there was no interest paid on those reserve balances. Beginning in October 6, 2008, the Federal Reserve began setting interest to be paid on those reserve balances. We have President Trump calling for lower Fed funds rate. Many people believe that Fed funds rate will drop to zero when the Fed chair is replaced in May. And many people believe that Trump will appoint his yes man that will get that rate down to zero. But will that Fed funds rate affect mortgage rates and the economy? Let's look at the mortgage rates. When the Fed raises the Fed funds rate, it becomes more expensive for banks to borrow money. Typically, those higher interest rates trickle down to higher mortgage rates, but not necessarily. And the lower Fed funds rate would typically trickle down to mortgage rates and lower the mortgage rates, but not necessarily. And most people believe that if we can get the Fed funds rate down, we'll get the mortgage rates down, the housing market will pick up, and the economy will flourish. But that's not necessarily the case. The mortgage rates are more tied to the mortgage-backed securities. So the more demand you have for those mortgage-backed securities, the lower the interest rate is, the lower the mortgage rates are. So we could actually see a decrease in the Fed funds rate and an increase in mortgage rates. So what role does the Federal Reserve have in the price of the mortgage-backed securities? Well, that's the quantitative easing, quantitative tightening. The more the Fed purchases those mortgage-backed securities, higher demand for those securities, the lower interest rates, the lower the mortgage rate. So I think that we're likely to see more purchases by the Fed of the mortgage-backed securities in a quantitative easing period, and that should cause mortgage rates to fall. Unfortunately, when the Fed purchases mortgage-backed securities, this causes a distortion in the housing market like what we see today. This causes more financial instability. So whether or not the Fed would be able to purchase mortgage-backed securities and enter into a phase of quantitative easing to get the mortgage rates down, that remains to be seen. Check out our interview with Jeff Sicking, a loan officer with Prime West Mortgages, for his insight on mortgage rates for the rest of 2025 and going into 2026. And as always, thank you for joining us. And don't forget to like and leave your comments below. Help us grow our channel. And then subscribe to our channel and check out our other videos.